What happens when money dies? How currencies collapse and assets survive. One. The central question. When a currency collapses, what happens to the assets priced in it? Do they vanish? Crash to zero? Or quietly migrate to the next monetary system? History gives a clear answer. Every major hyperinflation tells the same story: money dies, but assets adapt. So what does that actually mean? It means wealth doesn't disappear, it changes its costume. Footnote. This section introduces the question of asset survival during currency collapse, noting that assets persist while the measuring unit changes. 2. Inflation, not deflation, kills. Currencies don't die of deflation. They die of excess, too many notes chasing too few goods. Hyperinflation, not economic drought, ends empires. It happened in Germany, Venezuela, Zimbabwe, Turkey, and Lebanon. In every case, money printing was the weapon of self-destruction. Footnote. This section asserts that currency collapse historically results from overproduction of money, never from scarcity or deflation. 3. The dollar's quiet dependency. For decades, Americans have lived under a stable illusion: savings accounts, 2% inflation, 9% stock returns, and everything priced neatly in dollars. But priced in and denominated in are not the same. A mortgage is denominated in dollars, you owe a fixed number. A stock, gold bar, or Bitcoin, however, is merely priced in dollars, it can switch its pricing unit anytime. So what does that actually mean? It means your wealth isn't tied to dollars unless you let it be. Footnote. This section differentiates between dollar denomination and pricing, emphasizing flexibility in non-debt assets. 4. The crisis of overprinting. The pattern is predictable. A crisis hits: wars, pandemics, recessions. Governments panic and print. Like 2020 stimulus wave, money floods the system unevenly. Those who touch it first, the government and its partners, spend it before prices rise. Everyone else pays inflated prices later. It's a legal wealth transfer disguised as relief. Footnote. This section explains how uneven money distribution during crisis-driven printing creates inflationary inequality. 5. The saver's trap. Inflation punishes savers. The cash in the bank buys less every year. To protect themselves, people chase returns, stocks, real estate, anything that bleeds slower than the dollar. Eventually, stock prices detach from earnings because nobody's investing for growth anymore, they're just running from decay. Footnote. This section notes that inflation drives speculative behavior by making capital preservation impossible through savings. 6. The inflation feedback loop. Printing to fix crises creates larger crises that require even more printing. Every bailout plants the seed for the next collapse. Lebanon, Argentina, and Zimbabwe are modern reruns. The currency weakens, people panic, and everyone starts spending faster, desperate to escape their burning money. The result? A vertical stock chart that looks like salvation but isn't. Footnote. This section describes how repeated monetary interventions amplify instability and accelerate inflationary collapse. 7. Parallel economies emerge. When trust in a currency breaks, citizens improvise. In Lebanon, they transact in dollars. In Argentina, euros or gold. In Germany's Weimar era, people bartered bread for coal or gold dust. Hyperinflation creates multiple economies running side by side, the collapsing one and the one already living in the future. Footnote. This section observes that people naturally adopt parallel currencies and barter systems when the primary currency fails. 8. Stocks in a hyperinflation. During hyperinflation, stock markets appear to boom. In truth, they're just keeping up with a dying currency. Venezuela's market rose vertically, but only in bolivars. The same happened to Germany's Reichsmark stocks. When measured in gold or dollars, they barely moved. So what does that actually mean? It means the illusion of wealth persists until someone changes the ruler. Footnote. This section highlights how rising stock indices during hyperinflation reflect currency debasement, not real value gains. 9. The currency reset. When a currency finally dies, two paths appear. The government can issue a new fiat with fewer zeros, usually a sequel to the same failure, or adopt what the people are already using, gold, silver, or foreign money. The first path always fails again. The second usually stabilizes because it rebuilds trust on reality, not paper promises. Footnote. This section explains how new fiat currencies repeat old mistakes, while hard or foreign currencies tend to restore confidence. 10. Asset survival and repricing. When the dollar dies, companies, stocks, and houses don't vanish, they simply get repriced in whatever replaces the dollar. The transition is messy, but ownership persists. What collapses is valuation, not existence. Prices fall once the panic ends and a stable medium returns. Wealth migrates from those who held currency to those who held claims on real things. Footnote. This section clarifies that real assets survive currency collapse but undergo drastic repricing once stability returns. 11. The rational hedge. No one can perfectly time a collapse. But diversification cushions the fall, some gold, some Bitcoin, some stocks, some cash. Spreading bets means surviving multiple outcomes. Hyperinflation punishes certainty. Flexibility, not ideology, keeps the lights on. Footnote. This section recommends diversification as the pragmatic strategy for preserving value during uncertain monetary transitions. 12. The final lesson. In every collapse, cash dies first, arrogance second, and paper wealth third. What remains are skills, assets, and adaptability. Hyperinflation isn't the end of wealth, it's the end of laziness about it. So what does that actually mean? It means that in the funeral of a currency, the smart money shows up early and leaves before the speeches start. Footnote. This section concludes that adaptability and tangible asset ownership are the only reliable defenses against monetary collapse.